CoreWeave stock is surging more than 18% in pre-market trading after its results, but the most important detail was not its record revenue or even its $104 billion backlog. It was a new contract of NVIDIA's A100, an architecture introduced in 2020, extending all the way through 2029 at what the management called an attractive price. That challenges one of the biggest concerns around the CoreWeave, the rapid GPU obsolescence. But the CoreWeave could spend as much as $39 billion this year. So is the market celebrating durable AI infrastructure economics or overlooking an increasingly expensive debt-funded race? First, the Q2 report. Revenue reached $2.6 billion, growing 112%, while backlog increased to approximately $104 billion. That excludes more than $25 billion of commitment added in early Q3. However, adjusted operating margin was only 5%. CoreWeave reported $640 million of interest expense. The 18% stock price surge therefore suggests investors are prioritizing future demand, pricing, and raised guidance over the current profitability. Now, why is the A100 contract important? CoreWeave's CapEx comes upfront, while revenue arrives over a multi-year contract. And management says a typical 5-year contract can repay the asset level of debt funding that deployment. Afterward, CoreWeave can recontract the infrastructure or allocate it to a managed inference, generating additional returns after the initial financing is repaid. Management said its older Ampere and Hopper fleets remain largely sold out, with previous generation pricing at or above levels seen roughly 1 year ago. But one contract is not proof of the whole fleet. Investor must monitor renewal pricing, utilizations, and duration across more older GPUs. The second takeaway is pricing power. Q2 contracts are expected to carry contribution margins 5 to 10 percentage points above recent contracts. That came before July, when CoreWeave implemented an approximately 25% price increases across its SKUs. It is also passing higher component costs through customers. CoreWeave became the first cloud provider to bring up and validate the NVIDIA's Vera Rubin NVLink72 platform. Management described demand is enormous and linked much of the new contract margin improved to Vera Rubin. CoreWeave cited a Signal 65 estimate of TCO up to 47 below the average hyperscaler. Results vary by workload, but a genuine advantage could support premium pricing while lowering the customer costs. CoreWeave is also becoming more than a GPU rental company. Its storage, CPU, networking, and software businesses now exceed $400 million of ARR. Managed inference has scaled from approximately $1 million to more than $100 million of booked ARR, with at least $250 million targeted by year-end. Customer breadth is improving, but no updated concentration ratio was disclosed. Microsoft-related concentration risk remains. Now consider the power commitments. CoreWeave ended Q2 with 1.5 gigawatt of active power after adding nearly 500 megawatt. More than 300 megawatt arrived in June, so much of its revenue contribution should appear in Q3 and Q4. Contracted power has reached approximately 4.2 gigawatt, but this is not yet revenue producing the capacity. Another 1.5 gigawatts comes from powered land and options and letters of intent, making it less certain. Management expects more than 1.85 gigawatt active by year-end and targets at least 8 gigawatt by 2030. Delivery has commenced on contracts representing more than the half of Q2 backlog. But backlog becomes revenue only when CoreWeave delivers the infrastructure. This brings us to the biggest risk, the capital intensity. CoreWeave spent $9.4 billion in Q2 and raised full-year CapEx guidance to between $35 to $39 billion. Its weighted average cost of debt has fallen by almost 300 basis points, producing an estimated $1.1 billion of annualized savings. But debt is growing, so Q3 interest expense is expected to rise from $640 million to $860 million and $940 million. The company raised full-year revenue guidance to between $12.4 billion and $13.2 billion, and it's expected to year-end ARR to between $18.5 billion and $19.5 billion. So, the stock surge makes sense from the perspective of demand, pricing power, and potentially longer GPU asset lives. But it does not remove the execution risk and the financing risks. AI demand is no longer the main debate. The question is whether CoreWeave's assets durability, execution, and margin can remain ahead of the debt, depreciation, and capital expenditure. If you appreciate the research-driven analysis beyond the headline numbers, subscribe to Bhagat Capital. Thank you.